I was asked to talk about some of the areas of innovation and some of the disruptive forces acting on the banking sector. And so this is a subject of which I'm quite passionate about. Got Jimi Hendrix in the room somewhere here. But I thought I'd start with a simple story. As Uday mentioned, banking is a very traditional business. And if you doubt that, I wanted to share with you 3 products or parts of the banking system that have been with us a long time and show the heritage of the banking system. So the first is the word bank itself comes from the Italian word banco, which literally was a bench that they placed in the marketplaces in the trading areas of Italy. And in those days, the banker or the trader would sit there and exchange money and be at the centre of this and provide credit for certain transactions. And when this banker got into trouble, then the crowd would revolt and would come along and break the bench so he couldn't function as a banker at the marketplace anymore. The Italian word for this was rupture. So you get banco rupture, or bankrupt, which is what happened to these bankers who no longer had the respect of the locals. So we still have a very traditional business. In fact, some of the artifacts we use in banking go way, way back. There was a bill of exchange used on the Silk Road during the 1st century, around the turn of the century, particularly between the Chinese and Arabs as they conducted trade. And this bill of exchange, it was the Persian word given to this was called sak, which if you translate that today would be check. And this was the foundation of that original process of defining a bill of exchange that could be conducted for in exchange for goods and services. And then some of the early products that were introduced into the banking arena, such as the mortgage product, have a very interesting heritage as well. The mortgage actually started to, in the UK, started to emerge around the 12th, 13th century, and one of the primary promoters of the mortgage was a gentleman by the name of Sir Thomas Littleton, who believed that feudal lords should not have an exclusive right on land ownership, that the common man should be able to get access to ownership of land. The Latin word for the product or the concept that he came up with, allowing common people to own property in the UK, was vadium mortem. Does anyone know what the translation of that is? Who's got their Latin? Well, mortem is fairly obvious, right? Death, right? Dead. Vadium was a pledge, right? So, pledge of the dead or dead pledge. And I figure that the thinking behind this was you got to pay off the mortgage just before you died. I don't know, but if you take this Latin, vadium mortem, and translate it into French, for example, you get gage mort, or mortgage, mortgage. So we have so much history in banking that sometimes when we're presented with the idea of disruption or the industry changing, we look at it a little bit skeptically and think there's so much heritage in the way we conduct this business that there's a lot of inertia to get over. There's a lot of things that would have to change for banking fundamentally to be different. But let's look on the flip side. In the last few years, we've had, in the last century, we had a number of new technologies come into play which have been disruptive in their own right. When the radio first came along, it was considered extremely disruptive. It was going to stop people from sitting around in their family settings talking to each other or reading a book. You know, it was considered disruptive technology. The TV, when it came along, was considered disruptive technology. The internet, when it came along, was considered disruptive technology. But at each stage when these new technologies came along, people would scratch their head and say, I don't think things are really going to change and things aren't really going to be that different, and people aren't going to stop reading a newspaper just because we have a radio. People aren't going to stop listening to the radio just because we have this new television. And that's true. Life has got more complex. But at each stage, these new technologies have provided disruption and opportunities. And the first winners in this space, when these new technologies come along, tend to be those that own the platform, the networks. Right? So in the case of radio, it was the radio stations, the TV networks in the case of TV, and the big internet companies that own the content platforms. They were the first owners. And then comes along the advertising people, who think that we can send our marketing messages on these platforms and generate income, right? Radio first, you know, we have these entertainment shows and news, and then we start selling product. Same with TV, same with internet. And recently, with social media. And everyone thinks, with social media coming along, that the big opportunity is owning the network, being a Facebook or being a Google Plus or being a Twitter. This is where you make the real money, right? But then the advertisers come in on top of that and they start figuring out a way to send content across these mediums to try and sell you products. The difference between the internet and social media and technologies like TV and radio, however, was that these were interactive technologies. These could talk back. They were no longer just broadcast mechanisms. So different to TV and radio was this new layer of business that could sit on top of these new networks and interact in a very different way. The dot-com phenomenon was the start of this for the internet. And despite the bubble bursting in 2001, some of the biggest companies today have founded their business on the technology of the internet. And likewise, with social media, we sometimes scratch our head and we think, don't know how there's going to be ROI, don't know how we're going to make money out of this. But the real opportunity, perhaps, is that this is actually probably a platform for the creation of some very different businesses working in very different ways that haven't been possible before, but are now made possible through the marriage of community, messaging, and this really unique platform that we call social media. Now, in all of this, we have industries who then come along, faced with these disruptions, and say, but our business is different. These technologies really aren't going to fundamentally change the way we do business. And the first of those presented in the media business maybe was something like the Encyclopedia Business. You know? And Britannica, a 330-year-old company, started here in the UK, actually in Scotland, by 3 printers. This year, or sorry, actually it was last year, has stopped printing the Britannica for the first time in over 300 years. Thanks to, initially, technologies like Encarta, which demonstrated Microsoft Windows capability, and then later social media or collaboration built on the Wikipedia platform. And then you have newspaper print. Amazing to see the disruption of technology like the streaming technologies of today and the way print media has changed. Newspapers are in trouble. Inflation adjusted this year in the United States, less money will be spent on advertising in the newspaper sector than in 1950. That's disruptive. And as a result, the print business has undergone significant changes. Books have changed. We used to have a physical product, a book sold in a physical store. And then along comes Amazon in the 90s. And they started selling these physical products, these physical books, through an online store. But that was not the real disruption. That provided an impetus for change, and people started to buy their books online, and less people started visiting bookstores. But at that point, those traditional distribution mechanisms could still survive, because there was still enough momentum left in the business. Then along comes the e-book. Now the e-book on its own, a PDF if you like, wasn't that disruptive. Who's going to read a book on a computer? In fact, there's some great quotes on that. One that I've put in the book from Clifford Stoll, who wrote in Newsweek about Nicholas Negroponte. He thinks people are going to read books on computers. Is he mad? You know, this was the industry reception. But along comes a paradigm shift. Along comes a technology that feels very much like a book, but allows you to download a book into a Kindle or an iPad, and suddenly this is very much like the old experience we had, but a much more efficient distribution mechanism. At that point, bookstores start to fail. Bye-bye Borders. Bye-bye many of these smaller bookstores. Why? Because the distribution mechanics no longer hold the existing model up. Then you have a look at technology like music. Despite spending hundreds of millions of dollars, the MPAA, the Motion Picture Association, the Recording Industry Association of America, and these bodies who wanted to keep the traditional distribution of movies and music in a store with a physical product in a physical store, and along comes an online store that sells the physical product, and then comes iTunes and the iPod, the 99-cent single, and the complete disruption of the music industry. Bye-bye Tower Records. Bye-bye Virgin megastores. The distribution channel was broken. Now, it wasn't the technology that broke the distribution model. It was the technology that changed consumer behaviour which broke the distribution model. But banking's different, right? So let's have a think about it. We have physical products in a physical store. Physical artifacts of banking. At its very base, the banking system operates on cash, a physical product, but more so the productization, the essential product in banking is the bank account. So in the 60s, our bank account was a passbook. And we used to go along to the branch to get it updated. In the 70s, it was a checkbook. 80s, checkbook. 90s, an ATM card. Now a debit card. But what's going to be the bank account of the future? Well, clearly, one of these devices. Why? It's pretty simple, actually. This can be a payment device, but gives you a much richer experience than swiping a debit card, which can only tell you whether the transaction's approved or declined. This can tell you your balance before the transaction, after the transaction, allow you different payment options, give you a deal, allow you to see the impact of that payment. The value proposition is very clear. So, physical product, physical store, then along comes online banking, and we can sign up for a bank account online, get our physical product, the debit card, delivered by mail. But along comes the real disruptive technology that changes consumer behaviour. A digital bank account. A digital product that doesn't require physical distribution anymore. But you're forgetting. What about advice? That's what bankers are great at, right? But the problem is this. For 90% of the retail banking market, they actually never get advice in a branch. They want the utility of a bank account. But they're not that fussed about going to a branch. So when you can eliminate the physical distribution of a physical product in banking, and you've got a purely digital product, and remember this, banking products aren't like books. They aren't like music, CDs or records or even encyclopedias. They're far easier to digitize than any of those products. So the friction to get over in terms of breaking the physical distribution network in banking is far lower, except for KYC and IDV, right? Know your customer, identity verification. We've got to have a customer come into a branch to sign a piece of paper. So here it is, we are defending the distribution model of retail banking with friction that customers don't like. Where's the value proposition in the distribution model? As soon as someone can figure out a way to get rid of that friction, the physical distribution model is indefensible. Now, just like record stores and bookstores, not every bank branch will disappear. Some will remain. But the reality is most will disappear over the next 10 or 15 years. And this presents a problem for us because most of these businesses, we have a heavily geared towards an expectation that revenue is going to walk in the front door. And we've designed our entire marketing and engagement process around a funnel to get a customer into a branch and sign a piece of paper. and we advertise in newspapers. We send direct mail envelopes. We put commercials on TV and on radio. All of which, incidentally, are mediums undergoing their own disruption because of changing technology. So the funnel, that process of getting customers in the branch for acquisition, that itself is breaking down. And here we're worried about distribution model, but the fundamentals of the funnel that get customers into the branch to sign a piece of paper to get that physical artifact, these are being undermined by changing consumer behaviour and technology. Now, I often quote the statistics from the UK market that since 1990, the number of branches in the UK between 1990 and 2010 halved. That means one branch closed every day in the UK between 1990 and 2010. And that inertia has not slowed down. If anything, it's going to speed up. Now, we worry about how we're going to service customers and all of that, but the reality is, most of the time, when a customer comes into the branch, they're actually forced to come into the branch by our process. This is not necessarily the most efficient way to do things. And while I understand there is a generational gap here and some customers still prefer that face-to-face medium, there's a new generation of customers that will represent half of the retail banking population by 2020 who want to do banking in the simplest, most efficient way. And if you tell those Y-Gen and digital native they've got to come in the branch and sign a piece of paper, that's not a value add anymore. It's just friction. And that's the problem we've got right now today as an industry. We love friction. In fact, we have a special word for it. It's called risk mitigation. Right? This is where we have to change our mindset. It's not a risk to do things differently. It's a risk not to do things differently. Because every other business that has been confronted with this shift, with this change, that hasn't changed the way they do things, has been disrupted. And it's Borders, it's Blockbusters, it's Encyclopedia Britannica, it's Polaroid, it's the US Postal Service. Consumer behaviour is the killer app when it comes to business disruption. And, you know, you think about this. You think, well, what's the regulators going to say about this? What are the regulators going to do when all of these new companies can't start coming up with these new distribution mechanisms and new ways of engaging customers? Surely the regulator is going to have something to say about this. But here's the thing. Regulators don't regulate consumer behaviour. And they're never going to. So this is the trick with stuff like the recording industry. They tried everything they could. They spent hundreds of millions of dollars trying to defend their existing distribution model and failed. Not because iTunes was just a great distribution model, but because consumers changed the way they behaved. Are consumers changing the way they behave when it comes to banking? Well, they have been for the last 10 years, but the mobile is the real disruptor. The mobile changes the context of banking. Because in the past, we had to go into that branch to get through the hurdle of getting qualified to get a product. Whether it was a car loan, a mortgage, a credit card, we had a barrier to entry as a consumer. We had to qualify for the process. We had to get through that risk process. Otherwise, we didn't get the product. But that's just friction now. Ultimately, when you remove all the friction, what happens to those types of products? Well, think about it. Customers don't buy a mortgage. They don't buy a car loan. They don't buy a credit card. They don't buy travel insurance or a travel loan. What they do is they buy a home. They buy a car. They go shopping. They go on a trip. And ultimately, when you remove the friction and those problems that prevent the seamless delivery of financial services and products, then you just have those products embedded in your life when and where you need them. And that's ultimately where banking's going to go. Frictionless banking is about banking that solves a problem for a consumer when and where they need it. And friction is no longer a value in that process. It's just a disadvantage. It just makes you slow. It just makes you expensive, because the most expensive thing that you can do is force me to go into a branch and expend my time on doing something that I know is just simply no longer necessary. It's not a value add. So this is the disruption that we have to deal with. I'm always asked how quickly this will take place. Well, I think one of the real measures of this is that internet took, really, if you look at the commercial internet, it was about 94 that the internet emerged as a commercial venture. And it was around 2001 that we started to get internet banking becoming popularised, although there were internet banks before that. It wasn't really until 2005, 2006 that internet became the primary day-to-day banking channel for most UK or developed economy individuals. So, how long is that? About 12 years. What we know is that mobile, in terms of its adoption rate, is happening, and mobile banking is happening about 300% faster than internet banking did. So let's say it wasn't 12 years, let's say it was 6 years. When did mobile apps first appear? 2007. Add 6 years to that. Guess where we're at? This is probably the tipping point right now. Over the next 1 to 2 years, mobile will become the primary day-to-day banking channel. So mobile will be number one. And consumers will have contact with their bank or their money in an account 20 to 30 times a month through their mobile phone. It may just be as simple as checking a balance, but it may be using the phone to pay in a store. And they'll be using a tablet or internet to connect to the internet banking for things like bill pay and maybe structuring investments, reviewing their portfolio. They'll be doing this 7 to 10 times a month. They'll be using an ATM for a while longer, maybe 4 to 5 times a month. So these digital interactions, if you measure them, total them up, we're talking maybe 300 or 400 times a year that they'll be interacting digitally with their bank or their bank account. How often will they be visiting a branch? Well, maybe once a year, maybe twice a year as an outlier within the next couple of years. Incidentally, that represents about a 90% reduction in frequency of visits to the branch since 1995 for the UK population. Now, if you want a relationship with a customer, what are you going to do? You're going to choose that one time a year he walks into the branch, or you're going to try and have a relationship with him those 400 times he interacts with you digitally. See, we think that digital is an inferior relationship experience to the branch. But how can it be when you've got those sort of numbers stacked up against you? You've got to have a pretty special branch experience to protect your customer relationship with that one visit a year. If someone comes along with a really rocking mobile app, like Moven, or an online experience like Fidor, right, Matthias? So anyway, that's my thought about the disruption.